Okay, in this video we're going to talk about how you can construct your own swing trading or day trading gold trading system using ETFs, including the triple ETFs. So first of all, you have to step back and think, what does a short-term trading system involve? Because this is much different than long-term investing. First of all, it involves having a system. That's the key word. This isn't fly-by-your-night trading or seat of the pants or just what you feel like doing or something or going by your gut. That's not going to work because at some point you're going to see things go against you in a short-term trading system. And if you don't cut losses, you can experience devastating losses. They can just grow and just really be horrible. So you've got to use strict rules on when you're going to enter, when you're going to exit, when you're going to cut your losses. And all these rules are going to have to involve pure price action. You're not looking at fundamentals. You're doing very short-term trading. And in short-term trading, really, fundamentals aren't really a big factor. And let me suggest to you, in coming up with your system, to use two key concepts. First, to use multiple time frames to figure out your entry and exit points, and then to use technical indicators to do the same thing. So let's first talk about multiple time frames. The simplest example I can give you is use the daily trend and then align that with the hourly trend. Personally, if you think about when I'm using stage analysis or have been speaking about that and looking at entry points and charts, what I'm really looking at is two time frames. A very long-term time frame, that's the big trend, the stage of the market or sector, using the 200-day moving average. Identify the big trend and then use the daily charts for long-term entry points or sell points. So that's really what I'm really doing with my core positions and most of my decision making. However, now we're speaking about short-term trading, and the same concept still holds, but now we're looking at the daily trend and the hourly trend instead of a 200-day trend and daily trend. And one thing we can do is still use tools like I've shown you, such as the relative strength ratios of gold, to construct a trading system. So first, let's look at multiple time frames. And here's an example of something you could do. So here we're looking at the big trend in the market. I've got this box showing a down sideways market. That was the stage 3. It did really started years ago, but we came into this chart in stage 3. Sideways market circled. That was really the stage 1, and then the up move, start of a new bull market. And below, I have a overbought, oversold indicator. Everyone has their favorite indicators, but this is really the simplest one to interpret on a chart. It's the daily stochastics. And I use stockcharts.com. This is just simply their default setting. And when this gets above 80, that means things are overbought. When it gets below 20, it means they're oversold. Well, if you're in a sideways market or a down market, you really want to sell when this gets overbought. You can't ever expect to sell at the exact top, but that's what you want to do. So that was the way to use this indicator for sell points in a stage 3 market in stage 1, and you can also use it to buy, especially when things are going sideways. So if you look at this circled area, you can see how if you would have done that, and we're using GDX in this example, you could have made some nice little swings. You wouldn't have gotten out necessarily on exact bottom, tops and bottoms, but it's some swing trading going on. However, once you go into a bull market, the sell signals this generates don't really do you any good. The system breaks down because you really, in a bull market, don't want to be jumping out, in and out on core positions. That's more like day trading. And in a bull market, you really want to do holding of core positions, unless you're really trading the triple ETFs or doing something wild, which we'll talk about in a moment. But in the bull market, you can use this signal for entry points. So now we hit below 20 the other week on this example here. But we're really using, you can use multiple time frames here. This is really what we're doing. The 200-day moving average being used to identify the big trend, and then I'm using daily action and daily stochastics. But let's switch to hourly too. And you can use this indicator also for hourly trading, and you can see how up until really January the 19th, when the final bottom was made, this could have been used for entry and exit points. Not perfect. It wasn't perfect every single time, but it could have been done. And now it's better off only being used for entry points and not necessarily exit points with GDX. But what about Nugget? Nugget is so volatile, and remember, you don't want to hold Nugget for a long time because it does have this erosion factor that impacts it when it's going down or simply going sideways. This is an hourly chart of Nugget, and you can see how if you simply use daily stochastics on Nugget, you can make some good swing trades. So, for example, here, a lot of people use the stochastics and say the buy signal comes when it crosses back above 20. If you would have done that, you say you'd enter Nugget, around 54, 55, then you sell when it's oversold. You're now getting about 10 points on it. Here you have a huge swing up from the 50s up to 72. And if you want to short Nugget, you would have gone down from 74 all the way down to the 20 to below 54 and so forth. So, but we have been in a little bit of a sideways trend here. When this is in a bull market, it becomes very difficult to jump in and out of only by using this as example. However, you can really do things better with a gold trading system using these triple ETFs on hourly charts. If you use the GDX divided by gold ratio, that ratio gives fewer buy and sell signals than the simple ETF does, and this ratio actually tends to be an early sign that a rally is about to come for mining stocks and gold. So this is a pretty decent way if you're interested in day trading using these ETFs. Again, this is an hourly chart. What you're looking at here is the GDX divided by gold ratio. When this goes up, it means gold stocks are outperforming gold. When the ratio is going down, it means they're underperforming gold. And this is all in a very short period of time. But there are, even though in the big trend now, this ratio is trending up, and I expect it to continue to trend up, these short-term changes in the ratio can be used for short-term trading using the triple ETFs. So, for example, if you would have done this, and we have Nugget below here, this is the ratio. The hourly stochastics are giving overbought, oversold readings for the ratio. So the first oversold signal comes here, crosses below 20. The ratio starts to perk up. We had a little bit of a dip. The ratio picks up. We go from 55 to about 65. You get overbought. You say, okay, I'm taking my profits. I can't be perfect. I know I'm doing short-term trading. Short-term trading means taking profits. Then I'll wait. You get the dip back down in the ratio. You enter here around 55 or so. And then eventually the ratio shoots up. When it gets overbought, you've now cleared 67. You get out. You wait. The ratio finally gets oversold around here. You can see it cross back above 20. We're now here around 55 again. And then the ratio gets above 80. Now we're at 62. You once again wait. You dip below 20. You're at 55, and now we're going up. So at this point, you would wait to see the ratio get overbought. Perhaps it gets to 65. Again, you're looking for short-term swings, and since this is a triple ETF, the swings in Nugget can be fairly substantial and fairly big. But in order for any short-term trading system to work, you must cut losses, you must do this, you must have some sort of stop loss point. The simplest stop loss point, the one I have done when I used to do short-term trading, was to simply put a stop loss order below the previous low. Some people simply use fixed percentages, 10% below or something like that, another way to do it. I don't really engage in this type of short-term trading. I had done this sort of thing when I first started in the financial markets, but I'm much more of someone who wants to hold core positions. I use the model ETF rebalancing system to do that, something I'll explain in a future video, and then I do other types of investments directly with gold companies and some on the stock exchanges as position investing. These are things, again, I'll talk about in future videos in this course. I just wanted to talk about and show you in this video what you got to think about to create a short-term trading system. You've got to think about pure price action, strict rules on when you're going to get in and out, and some combination of indicators that are going to give you entry and exit points. Presented one system, but this is something you're going to have to play around with and apply those three things to anything you do. And be aware that what system may work for gold may not work for the S&P 500 or other markets. The nice thing about gold, though, is we have this interesting and fun ratio that I do use to look at the big picture of the market on daily charts. They can also be used on a very short-term hourly time frame. And shoot, you could break this even down to minutes if you really wanted to, minute charts, you know, if you wanted to try to compete with the trading robots. But here we are, and on to the next video.